The meeting that changed nothing and everything. Nothing dramatic happened in the room. No raised voices. No bold decisions. Just a scheduled meeting that ended on time, with notes filed and action items politely deferred. To anyone looking in from the outside, it was forgettable. But markets don't turn on drama. They turn on moments like this. To understand why this meeting mattered, we need to step into a period when uncertainty was already in the air, but not yet acknowledged. Data was mixed, signals conflicted, confidence still existed, but it required reinforcement. Institutions didn't feel threatened, but they felt uneasy, and unease has a way of concentrating attention behind closed doors. The meeting wasn't called to change strategy. It was called to review conditions, exposure levels, liquidity assumptions, contingency plans that everyone hoped would remain hypothetical. The goal wasn't action. It was reassurance, proof that nothing urgent needed to be done. The first reveal begins with what was said. Concerns were raised carefully, not alarms, questions. What if volatility stayed elevated longer than expected? What if liquidity didn't respond the way it used to? Each question was met with reasonable answers. Models were cited. History was referenced. The system, everyone agreed, was resilient. The second reveal came from what wasn't said. No one argued for increasing exposure. No one pushed aggressively for opportunity. The tone wasn't defensive, but it wasn't confident either. Risk wasn't embraced. It was tolerated. The absence of enthusiasm passed unnoticed, but it mattered. The third reveal emerged when the meeting ended. No major decisions were made. Positions stayed intact. Allocations remained unchanged. Officially, nothing happened, but unofficially, something subtle shifted. Participants left with the same exposure, but a different mindset. They didn't feel convinced. They felt cautious. That meeting changed nothing on paper, but it changed how decisions would be made afterward. And in markets, how decisions are made matters far more than what's written down. Because when conviction fades inside the room, it rarely returns outside it. What followed would show how a meeting designed to preserve confidence quietly marked the moment it began to drain. In the days after the meeting, nothing changed outwardly. Portfolios looked the same. Exposure stayed intact. Reports still showed balance. But decisions were no longer made the same way. The conflict didn't appear in price. It appeared in hesitation. Traders hesitated before adding risk they once would have embraced. Managers paused before approving size that previously felt routine. The language of certainty softened into the language of contingency. If conditions hold, if liquidity responds, if volatility behaves. Each conditional phrase chipped away at confidence without announcing itself. The tension deepened as this mindset spread quietly across desks. No memo was sent, no directive issued, yet behavior adjusted in sync. New positions were smaller, time horizons shortened. Exit plans were discussed before entries were approved. Risk was reduced, but it was treated as temporary. Liquidity reflected the same shift. Orders were sliced thinner. Execution was stretched across time. No one wanted to be obvious. No one wanted to be early. The market still moved, but it moved cautiously, as if testing each step before committing weight. What made this moment so dangerous was how rational it felt. Nothing in the data demanded urgency. Nothing in the news justified fear. Every individual decision made sense in isolation, but together, they formed a pattern. Conviction was being replaced by optionality. The buildup continued as minor stress events passed through the system. Pullbacks recovered, but more slowly. Support appeared, but only after probing. Each recovery reassured observers that stability remained. Yet each recovery also reinforced a new habit of waiting instead of acting. Inside institutions, risk discussions changed subtly. The focus shifted from maximizing return to preserving flexibility, from positioning for upside to preparing for surprise. These weren't defensive conversations. They were adaptive ones. And adaptation, when shared broadly, reshapes markets. Veteran participants sensed the shift clearly. This wasn't the start of a sell-off. It was the start of disengagement. Capital hadn't decided to leave, but it had decided not to commit emotionally. An emotional commitment is what absorbs shock before it becomes visible? The meeting had done its work, not by changing exposure, but by changing belief. Belief in how much risk was worth taking. Belief in how quickly the system would respond. Belief in whether standing firm was still rewarded. That belief, once weakened, doesn't announce its departure. It simply stops showing up when it's needed most. And the market, still unaware, continued forward, lighter, quieter, and far more sensitive to the next test than anyone realized. The next test arrived quietly, as if the market wanted to see whether conviction still existed at all. A modest wave of selling moved through familiar names. Nothing alarming, nothing new. In earlier weeks, this would have been absorbed quickly. This time, the response felt different. Buyers appeared, but cautiously. Size was smaller. Timing was delayed. Support levels held, but only after being tested longer than expected. The market didn't break. It hesitated, and hesitation was exactly what the meeting had normalized. The conflict intensified as that hesitation repeated across sessions. Each small dip trained participants to wait just a little longer before acting. Waiting reduced immediate demand. Reduced demand extended moves. Extended moves justified more waiting. The loop reinforced itself without a single headline to explain it. Institutional desks felt the pressure in execution. Trades that once cleared smoothly now required patience. Slippage increased in places considered reliable. Algorithms adjusted defensively, scaling back aggressiveness when reactions lagged. Not because risk was higher, but because confidence in response had weakened. The buildup accelerated when correlated assets began moving together. Diversification thinned quietly. Strategies designed to offset each other responded in sync, amplifying movement instead of dampening it. Risk models still looked acceptable, but behavior told a different story. The system had grown sensitive to timing. Inside firms, conversations grew more guarded. No one said sell, but no one said add either. Exposure stayed intact, but commitment did not. Capital hovered instead of anchoring. The market was still supported, but only loosely. Veteran participants recognized the danger clearly now. Markets don't fall because everyone decides to sell. They fall because no one decides to buy with conviction. And conviction had been quietly sidelined during that meeting, replaced by optionality and caution. As pressure persisted, even small surprises felt heavier. Data points that once passed unnoticed now moved prices. Not violently, but persistently. Each reaction felt slightly larger than it should have. The market wasn't overreacting. It was undersupported. The meeting that changed nothing on paper had now changed everything in practice. It had taught participants that waiting carried less risk than acting. And once that lesson is learned, it spreads quickly. The stage was set for a moment when waiting would no longer be enough, when the market would demand a decision. And when that decision arrived, it would reveal just how much conviction had already drained away, silently, rationally, and without anyone officially choosing it. That decision arrived not as panic, but as inevitability. A broader move unfolded, measured, persistent, and impossible to ignore. Levels that once held with ease were tested and crossed without resistance. Not because sellers overwhelmed the market, but because buyers never truly stepped in. That was the climax. The market didn't collapse. It recalibrated, and that recalibration revealed what the meeting had quietly set in motion weeks earlier. Conviction had been replaced by caution. Support had become conditional. And when pressure finally required commitment, the system responded with delay instead of defense. As prices adjusted, explanations followed quickly. Analysts searched for catalysts. Commentators debated causes. But those narratives arrived after the fact. The real cause was an event. It was a mindset, a collective decision to wait rather than act, made quietly in a room where nothing officially changed. The resolution unfolded in behavior, not headlines. Capital re-entered selectively, but on new terms. Positions were rebuilt with wider margins for error. Time horizons shortened. Liquidity was offered carefully, not generously. The market stabilized, but it did so without the confidence it once took for granted. What lingered most was a lesson. Markets don't need dramatic decisions to change direction. They need subtle ones that alter how people think about risk, timing, and responsibility. A meeting design confirmed stability can undermine it if it replaces belief with caution. That meeting changed nothing on paper, but it changed how participants felt about standing firm. And when belief quietly leaves a room, markets feel it long before charts ever do, because the most powerful forces in markets are rarely the ones that announce themselves. They're the ones that make waiting feel safer than acting. And once that shift takes hold, the path forward is already being rewritten, step by hesitant step. So what do you think? How many nothing meetings are quietly shaping the market right now? The